So thank you so much for taking out the time to come here. It's especially commendable that you're here, given the situation, given the news last night. I really, really appreciate it. This is the third Mint Horizons event. Our first one was in Bangalore at BIC, which is interestingly modeled on the India Habitat Center. So lots of Indian cities are copying this very wonderful model, this wonderful place. Second one was in Mumbai, and this is the third. And we hope to do many more across India. I got 2 calls from my family this morning. So one I tweeted about, my aunt from Bombay calling me to check on my safety, and then saying to me that were there sirens, alarms? And I said, no, not in Delhi, not so far. At least this morning I had not heard of any. And then I asked her, anyway, if there is one, what do I do? And what will you do? And she said, nothing. I've just created a file with my FDs and my PAN card and my Aadhaar card in case anything happens. And then I said to her, but that's online anyway. But for her, that was security. So money is never far from our minds, even in times like this. Whether it is the Ambanis applying for the trademark on the operation, or whether it is somebody as middle class as my aunt in Mumbai thinking about her FDs. It's never far from our mind. The other call I got was from my mother. So she has a lump sum to invest, and she asked me today, of all days, where should I invest? And I said, okay, we'll do a 60-40 split. 60% I put in a hybrid fund, which puts mostly in bonds, so it's practically a debt, low-risk investment. 40% I said we'll put in an equity fund. And then she said, stock market, in this time, there's apprehension, right? There's worry. And I said to her, yes, but some of it also invests in other markets. Some of that fund also invests in Brazil and in US, some sectors, and it's a diversified fund. I'm not taking the fund name because people then say you shouldn't take names of funds, you're biased. So, but it's quite a popular fund. So, so money is never far from our minds. And I would say there is no better time to think about global diversification than the present circumstance. And it is actually a service to our country, because ultimately we're going to live here, spend our money here, pay taxes here. So if we do well as investors, we are benefiting our own country. So with that, let me begin the presentation. There's always a lag with every clicker I've ever used. Okay, yeah, we can stop here. So some of you might have seen this debate on Twitter with Mr. Harsh Goenka pointing out how wars lead to economic issues and slowdown in business, and therefore financially it affects you. And he got trolled massively. Why is he thinking about money at this point of time? It's about our country, our lives. And here's Devina's reply to that tweet, saying that war has costs even on the victor. So it's not to be taken lightly. It's something that indeed does affect us financially. So this is the rupee-dollar exchange rate over the years. So it's 100 USD to INR. So basically it was 3 rupees to a dollar in 46, 3.31 rupees to a dollar in 47. So that proverbial 1 rupee to a dollar is just a WhatsApp forward. It was close, but not exactly 1 rupee to a dollar. And then over the years it falls. Not massively, so if you see it's going from 3.3 rupees to 4.78 by 64. ठीक है, मतलब it fell, but not massively. Then something happens in 65. What happens? War. We fight our first major war against Pakistan in 65. and a certain date comes along. Does anyone know what that date is? It's etched into our economic history. It's a very unfortunate date. Right after that war. So the date is 6/6/66. And it's significant because on that date, the government devalued the rupee by 56%. By 56%. The rupee was controlled back then, though. Right now it's a managed float, so every day it changes its value. Back then the value was set by the government. 56% depreciation. This is the Times of India. By the way, they've calculated wrong. They've said here it's 36.5. But because they've calculated it on the amount it fell to rather than the amount it fell from. But hey, I don't work for Times of India, so I can point that. So this is the other chart that fascinates me the most about global diversification. And this is the share of different countries in the global investment pie. So I don't know if everyone at the back can see it. I'm going to try and read out as many values as I can. If you still can't see it, please take this chance to come and sit in the front, because that will maximize your own, what you take away from today's session. So please come in front. Some of the charts might be a little bit small. So we start in the year 1900. This chart, by the way, is produced by UBS. There are 3 professors who compile this every year. It's called the Global Yearbook. In 1900, which is the country which would have the highest share in the global stock market pie? US, India, no. UK, right? British Empire. British Empire. So this bit here is 24% GBR, Great Britain. And US is actually less. So US is just 15% in the year 1900. Then you see how Britain has moved. So this is this area here. It's slowly stagnated. A century and a quarter of slow, gradual decline in relative terms. And Britain ends the chart here in, I think they did this in 22. So it says 20, but it's 22 or 3 with 3%, right? They go from 24% to 3% of the global market pie. Now this red, this giant red part is of course the United States. And even in 1900, 15% was not small. And it rises. After 1970, it falls. It falls because another country has a stock market explosion. Which is that country? Japan. Japan takes something like 40% of the global market cap in the late 80s. And there is that famous statement that the land under the Imperial Palace was more than the entire real estate in California. The worth of that land was more than the entire real estate in California. And that was a bubble. So Japan burst. And you see Japan contracting down to 6%. Now, you might ask me, where is India in all this? Unfortunately, the professors are looking at it from a global point of view. They're based in London and the US. India is not there. Even now, we're at 3%. So even if they had to put India, they'd put it maybe somewhere here, some tiny bit here. We'd have to struggle to see it. And when you think about what this means, so I did a survey on Twitter that how many people have some of their portfolio outside India. 80% of people responded with 0. The remaining 20 said, some said 20%, some said 40%. So when we have 100% of our portfolio in India, or even 80 or 90%, we are in a global small cap. We are in a stock or a market which is 3% of the world. The prospects are bright. There is no doubt about it. We've all benefited immensely from it. But that doesn't take away from the fact that it's one basket and it's 3% of the world. So how do you invest abroad? For many years, mutual fund industry has provided a very easy option. You buy a feeder fund just like any other mutual fund, you invest. you redeem, same capital gains tax as debt funds. And now, of course, the tax treatment has improved further after the 2024 budget. After 2 years, you're only paying 12.5% capital gains tax, on par with a domestic equity fund. The problem now, of course, is that RBI has not raised the industry limit that it hit of $7 billion. And so most funds have stopped flows. Some of them open it whenever people redeem and then close it as soon as the limit gets hit again. It's a bit like a bus, one person gets down, then you can get in, then again somebody else has to get down, then somebody else gets in. It's that situation. It's artificial scarcity because we have very, very large forex reserves. I think $600 billion of forex reserves. So if you think about it, 7 billion is nothing. But of course, in their wisdom, they have decided to keep that limit as is. The limit was set in 2008, so it's not really accounted for the growth in our economy, in our capital markets. But be that as it may, that doesn't mean all options are closed. That leaves us with the second option in the room, which is RBI's liberalized remittance scheme, where the annual limit is $2.5 lakh, right? Which is a huge amount. For most middle-class Indians, even HNIs, it's quite a substantial amount. And that's every year. Then there is the TCS, tax calculated source, which applies if you have invested more than 10 lakhs. Yeah? Everyone's up to date. This is awesome. More than 10 lakhs. So this budget raised it to 10 lakhs. It was 7 lakhs. This budget raised it to 10 lakhs. And some of the issues with tax reporting also have slightly been eased. So earlier there was this huge fear that if you made a mistake with reporting inadvertent also in Schedule FA, there would be a huge penalty, prosecution. But in that 2024 budget, Finance Minister said up to 20 lakhs, we will not levy penalty. So the direction has been largely positive. Equalization of tax rates after 2 years, 12.5%, whether you have Apple stock or whether you have Reliance Industries here, whether you have Vanguard ETF in the US or whether you have Nippon ETF here, it's the same. It's neutral. It's tax neutrality. Fantastic thing. I think something that Dhirendra and many others in the financial industry argued for a long time, and they listened to their voices. Okay, guess the fund. Give me the full name because the part of the name is there, but yeah. Motilal Oswal Nasdaq, right? This is a pioneer, an early fund in the international investing space, launched way back in 2011. I think it was a tukka. Like I've spoken to them about it, like what was their thinking, and they just said कि बहुत सारी चीजें हम launch करते उसमें ये एक डाल दिया. But the people who got into it obviously made a killing. Return since launch 21.88 CAGR, far more than even our bullish domestic market and our active funds. Again, personal anecdote. So, I've had many investing mistakes in my past, but one of the few successes I've had is telling my dad to invest in this fund, in this ETF, in 2012. So I didn't catch the whole 21.88, but somewhere close. All right, guess the fund. HSBC Brazil Fund. Most of you won't even have heard of this fund. This fund was launched around the same time as Motilal Nasdaq, May of 2011. So mutual funds have this thing where if something is in, then they launch tons of things around it. So global investing was in back in 2011, 2012. If you remember, our stock market sort of went nowhere after the Great Recession. So after 2009, after it recovered from that dip, till 2014, right? Just went on in a band. Yeah, in a band, in the range. And so global investing became popular, launches happened, and the CAGR of that fund is minus 2.74%. It has destroyed wealth. So what I want to emphasize is that global investing is not a one-way ticket. You have to pick the right market at the right time. So I just did a rough calculation. This is a little dated as of April 25. But if you had just averaged your money. So if you had put 5 lakh in Nasdaq ETF, 5 lakh in Brazil fund, you don't know which will succeed. Averaging it out, you would be at 16% CAGR. The Nifty CAGR over the same period was 11.8. Small cap was 16.6, so similar, but you have to think how many of you would have put 80% in a small cap fund, right? So both categories have done well. And so a diversified portfolio, half Nifty, half small cap is at 14, which is still less than the 16 that you would have done if you had done half Motilal Nasdaq, half Brazil. Again, the idea is not to say that, look, this is a killer option to generate huge returns. It's about diversification. It's about, Saurabh Mukherjee, who came for our Mumbai event, he put it really well. He said, जब यहाँ दिन होता है तब वहाँ रात होती है, जब वहाँ दिन होता है तो यहाँ रात होती है. तो अगर दोनों में हो आप तो आप average out कर रहे हो. As they say, the sun never sets on the British Empire, so the sun never sets on your portfolio if things go well. So this is again from the global year's return fact book that I showed you at the start. It basically tells you how exceptional America has been in the very long term. So 1900 to 1999, the real USD return on US stocks has been 7%. And that has held up even in recent past 24 years. So, 4.95%. This year, of course, has been an exception, and we'll talk about the things that are unfolding this year and whether this means a big shift for all of us. My 2 cents on it is, again, going back to that first chart of the global market pie and the colors, taking space, losing space, is that even if the prognosis is that the US red splash is going to come down, I think that is a very strong opinion of people who are watching events. It doesn't necessarily follow that India is going to take up that color. That share might get distributed among different other countries, which those are, there is no clear answer. That's something that we hope we can figure out through discussions like this, through various resources. Again, kind of showing you the same thing about the US market, about how concentrated it is. So 35% is in the largest 10 stocks. Now, in finance, it's usually in presentations you will find people use very simple anecdotes and things, but I'll prefer scientific rigor wherever you can get it. So the same report tells you the Sharpe ratio. Ultimately, return theek hai, risk theek hai, but if you want to combine both, the Sharpe ratio is one of the accepted ways of doing it. And the authors find that in most countries, so if you were a Belgian investor or a Brazilian investor or a New Zealand, so these are all country names that they have put, your Sharpe ratio actually goes up if you diversify globally. Everyone knows the Sharpe ratio, right? This is something we talk about in this series. Today, unfortunately, we are not, but other topics, and do tell us if you would like us to come back and talk about them also. So global immigration, so EB5 visas, what's happening with that, travel, credit card. My colleague Shipra is here, she writes a lot about credit cards and how things, how you can maximize returns from them. There's something called return on spending, like the bank is paying you money to spend money. And if you don't get caught in the debt trap, then you actually make some additional money. So you can catch her in the break and ask her about it. Again, this is something that all of us already know. I won't spend time. Most of us would have relatives, family living abroad. So we are already kind of diversified. Our families are hedged. They are in different locations. But that should also make us think about investments being diversified. That's it. With that, let me invite Dhiren on stage. Most of you would know him. He needs no introduction. So I'll give you the uncommon introduction. All of you would know value research. Yeah, they're setting up the chairs. I'll just quickly introduce him. So Dhiren began his career in personal finance in the early 90s when he was clipping data from Economic Times and creating the first database of, but mostly Dhiren, I mean, they worked for him, and creating the first database which later on became Value Research, to which we all refer to for mutual funds, for stocks as well these days. And he was also my first boss. He brought me to this city, which I grew to love. So in that whole Delhi-Bombay debate, I am very much on the Delhi side. And it's always fantastic. He remains my guru, my mentor. So since you guys are in Delhi, do try and meet him whenever you can. But Dhirendra, thank you so much for coming. Please.
I came with a long speech, but most of the thing has been sorted in terms of the factual stuff. So as you have set the tone, so I wrote one of my column and I'll read it out. No, but it's the most important question. Should I stand?
As you
Would they like me to stand or will okay. Yeah.
Can everyone at the back see Dhirendra, or would you prefer that he stands? There's a podium as well. So raise your hands if you can. Yeah. We'll check Dhirendra's mic, but can you guys see him, or would you prefer for him to stand? If you'd like him to stand, just raise your hands. Otherwise, okay. Okay.
Right. Sure. All right. As the tone has been set for my talk, for which I was invited to, was talk about international diversification. And the tone has been set that why you should. And the very reason why you invest in a mutual fund. There are different diversification for which you diversify differently to reduce your risk, not to optimize return, not to really. Okay. Okay, you want me to be there? Yeah. I'll start all over again. Oh, wait. 1 second. This fine? Okay. So thank you for being here and inviting me. Most of the things have been clarified, and I find that you're an extremely knowledgeable audience here who knew most of the things which in terms of information. So I'll just share some perspective in terms of why we diversify, just to reduce our risk. And also because we don't know enough about anything. We just don't know what, anything which surprises us. And most of the things turn around. And the way we are configured, we always chase recent, well-performing asset classes, well-performing things, well-performing, careers, jobs, locations, real estate. So any asset class. So there's nothing unusual about it. And things turn around when we least expect it. When we think that we have complete confidence, we know it all, nothing can go wrong, things turn around. And this is something which has been repeating time and again, whether it be technology, whether it be the IPO boom of 90s or the infrastructure boom or more recently now. So if you look at any segment of the market, so there are a couple of things, basic fundamental truth about the market and its behavior and the way we engage with it or the way we participate is that every component of the market is cyclical. Nothing is in for a straight run. Nothing, and so is for the stock market, the segments of the market, the geography, the sector, likewise, you spread your assets across asset classes, asset allocation, everybody is being told, that's the first lesson. You reduce your risk by not investing all your money in equities. That's a long-term asset, and you de-risk yourself. We have our jobs here. We have our careers here. We have our assets here. We have our inheritance here. And that is all there that we have. And by the very design of our economy, it's, I remember that, one of my youngest siblings in my family went to the US long time ago. And that was, first time came back, the dollar was 14 rupees. So that was really, unusual. Then when Neil was here, started his job, one fine day we came to our office and Brexit got announced. And we were in for a surprise. The 20% slip on the on FT 100, that was your FTSE, 20% decline in a day. And that is when, when I was looking at the graph, I was just trying to figure out that which year was it? Was it 2018 or 16, around that? And it has really shrunk from there on. So everything turns around, and we just don't know about it. Then looking at the real numbers, we are really not only small cap, we are a tiny blip. And that too, accidentally we are a blip which is visible today. I was looking at the numbers, and I was asking one of my colleagues to give me the numbers of the global market cap and how do we stack up. $126 trillion is the global market cap. And it's not the market cap of all the companies, unlisted ones and all that. I'm talking of the listed universe only. 125 trillion, just for sake of ease of calculation. And Indian market is just 3.5% of that. That too, when we are so lucky, when the market has gone up dramatically, and we are so hopeful. So in that sense, I will just I have nothing more to add here on the conceptual framework, as all of you are here. So I'll just read out. I was writing my column, the next column, and this was more in the context of I got thinking about what to talk here and the point to be made. So a reader asked me recently, what percentage of one's equity investment should be invested in foreign stocks? That's a key question. And it's a common question. Everybody thinks that there has to be a formula. There has to be a formula to everything that we do. And there isn't one here. Because, there isn't a tidy number, perhaps, 20, 30%, or that, I come across this. Everybody asks about gold, and most people say very confidently that it must be 5% and it shouldn't exceed 10%. And I don't know why. So I was just trying to look for the theoretical basis to it. What is the premise? Why? And I really don't have an answer. But I have an answer for this global investment. The answer is that there is none. You should be investing your long-term money into equity. You should not be investing your long-term money, short-term money into equities. You should not invest all your money into equities, because you must have some asset allocation even if you're a very long-term investor. You should diversify your money. And going by whatever it is, and when investing for the long run, diversifying your money, then I will be entirely meritocratic in my decision. So if I have a wherewithal to list all the companies in the world, and which matches with my time frame and find the most attractive one, it could well be 100%. But I will take into account the risk. And in the risk assessment, what will come in very handy is what I'm familiar with. What I'm very familiar with is something that is what actually brings us to the home country bias. We know all the companies. I come across all the people in my vicinity, in my neighborhood, and somebody will be very passionately talking about a company where he has worked in his early years, and he says that this is a brilliant company and this is how it is managed and this is how it will grow. And when you figure out, it turns out to be a 6,000 crore company, which even in the Indian context might be a very difficult thing to really make sense of, or diversify, or be very focused on that. So discussing, debt versus equity allocation, we deal with fundamentally, a different asset class, different characteristic. Debt is predictable. So What about Indian versus American versus Japanese equities? What was being talked about. I would like to bring one point which you should take back is that we were talking of this American market, a very concentrated one, top 10 companies accounting for 35% of the capitalization. And it looks like an American company. It is not. The whole framework of technology or technology dominating the business is that there's a very significant, character. There's a big, there's a character that the winner takes it all. You don't need the second Google. You don't need the second Netflix. The network effect, the scale effect, or all those things. You don't have the second Microsoft, even though you had all kind of operating systems. And that is what actually corners it. And then they are not American business. Their customers, how do you define the domicile of a business may not be its, we can say that it's an American business, but it has its customers all over the world. It is being made all over the world, and it is being sold all over the world, and it is getting inputs, and that leads to that domination. So there must be something to it. And global MNCs. I'm not talking global MNC, but I'm talking of technology business. Technology business itself. I'm not talking of even the services business. IBM, after becoming a service business, never went about dominating a thing. Here we have a technology product and services of a kind, which by its very design turns out to be the winner takes it all. And the winner takes it all makes it a very unusual business. That is an unusual competitive advantage. That is a great business to have. So that is one concentration which I would like to have, because in the foreseeable future, I don't see that changing. There will be a churn. But even if what he was talking about, the NASDAQ 100, some of you might recall, that I used to do a television program called Investor's Guide on ET Now for about 10, 12 years. And that is when ET Now started. So we had one aggressive growth fund. And I took the courage of allocating 25% into NASDAQ 100 soon after its launch, when it became available to Indian investors. After the start of that portfolio, sometime in 2012 or so, it has even now, we still continue to maintain it in one of the value research accounts, and it turns out to be one of the best performing portfolios of ours. And I have a lot of fan following only on account of the people who chose that, and I owe it to that NASDAQ 100. Most of the return that you're referring to. And then we got a more concentrated version of the NASDAQ 100, which was FANG Plus. That FANG Plus is 10 companies, 10% allocation to each. And that the long-term return ever since it came into being is twice as much as NASDAQ 100. Because it is the top 10 of the NASDAQ 100 which dominates that. One company is in that FANG Plus, which is not part of NASDAQ, but so I would say that think of equity for your long term, think of international investing. Now, how to go about it? I would say that I'm extremely conservative person when it comes to taking chances with your money, choosing a vehicle. And so the bad news after all this talk is that you don't have a reliable vehicle. You can't do it now. And if you do it now, you have to pay 10 to 15% premium. The FANG Plus is available because it's a finite supply. It's listed in the market. Today it closed at 12% premium to its NAV. Likewise, NASDAQ. Likewise, there is a Motilal Oswal Quality 50. So all these which are ETF listed, they are at 10 to 25% premium to NAV, which I think is a foolish thing to do. But wait for an opportunity. You don't have to really rush. You have lived with your domestic equity all these years. All other avenues, that it comes with a lot of headache. Anybody, unless you think that $250,000 is worth taking a chance, and my biggest worry is not about whether you'll be able to get a vehicle which will be regulated and your money will be safe or secure or not. There are brokers which are very well capitalized. They won't run away with your money. But once in a while, they go under. But most of the cases, my bigger worry is there's a withholding tax. And it's extremely difficult to deal with our tax guys. When you get your money back, leaving the trail and giving explanation with your own money, which you just chose to invest elsewhere, I find it very cumbersome. I find it very painful. And even though he is very lavish with his appreciation that okay, things are improving, or it's not all that difficult, it's not so. Things are extremely painful when it comes to individuals dealing with tax guys. And they have very less comprehension of what actually happened. And they look at it, and not only that, I also dislike the whole way of remitting our money and the cost of remitting it and getting it back. I find it extremely taxing. It's almost like an entry load, the remittance itself. So thank you very much. The good news is that you will go back with an understanding that you should invest abroad. The bad news is that you can't. Thank you.
All right, so I'm just going to ask Dhirendra 3 questions and we're going to open it up to you guys. On the points about withholding tax, so there are UCITS ETFs which do not have withholding tax on dividends. And we'll get into that a bit more in Zinc Money's presentation. And there's also Gift City, which I'm going to ask Dhirendra about in my third question. But I think that's opening up a new avenue for Indians to invest globally. So some of you might know we do this thing called Guru Portfolio, where we ask people in finance how they manage their own money. And we did it with Dhirendra 2 years ago. So we're going to do a slight refresher. Dhirendra, if you can give us a update on that.
No, I'll maybe if it's of any interest to you, any of you. I started learning about investments and mutual funds in 1991. That is when I founded Value Research, and it was entirely driven by that curiosity. And that was the time when a lot of people think that mutual fund has really taken off now. Not really. In 1990, even till 1992, when SEBI came into being and mutual fund was opened up for private participation. Before that, only public sector funds could launch and run their mutual fund. And there were 8 fund companies: UTI, GIC, LIC, SBI, Can Bank, and 3 more: PNB and Indian Bank and one another, Bank of India. So 8 companies. And the size of the mutual fund industry then was far bigger than what it is today when I think in terms of relative terms. Because and that was and they were, they were actually fulfilling a need which was not filled, they were democratizing market. There was no other way investors could invest in market. Just to give you a context of that initial years, 1992 in Delhi, UTI launched a fund called Master Gain. Some of you might remember. And that was the month of May. Great Indian Scam was also underway, not unearthed. And everybody queued up at Bahadur Shah Zafar Marg. The queue was so, there was the crowding was so bad that police had to do a lathi charge to clear the roads. Can you imagine people queuing up to buy in mutual fund? And the craze about that mutual fund was so bad that, some 65 lakh people invested their 4,800 crore in 1992. If you adjust that 4,800 crore to today's Sensex value, assuming it was an index fund, that will start as an IPO of something like, dividend adjusted, something like 85,000 crore rupees NFO. 85,000 crore NFO, I can't imagine even today. That's one. Then, people mostly used to buy stocks, small investors from IPO. And brokers will not let them into their office because it was a very risky business for them. There was no I'm just giving you the context that what was the role. Without the depository, without the dematerialization, you sign a paper which is a transfer deed like selling your land, attached to that. I don't know how many people have experienced that. I recently landed up with some share certificate with those transfer deeds. So it was bad, it was cumbersome, it was not accessible. And mutual funds enabled that. Now coming to my own investment journey, I did not invest for first 5-7 years at all. In those days, there used to be a section called, but I have been a taxpayer from year one of my work life. I have never taken up a formal job in a company. So that was, there used to be the section under which you could invest 10,000 rupees and get a tax break was section 88. And the total investment that you can make every year under section 88 was 60,000 rupees. And government was very obsessive about controlling everything that you do. It shows even sometimes in NPS and other things where they design things. But those days they said that, 10,000 here, 50,000 in PPF. That was 60,000 was the entitlement, tax saving investment entitlement every year, on which you will get a 20% rebate. So those investments that I made, I still hold them, and they turn out to be, a demonstration of the long-term success story of a diversified portfolio in equity. I still hold quite a few of them, and they have done wonders to provide me a foundational, asset base. Then first 5-7 years, I just did that 10,000 rupee. And rest of the money I could not invest, despite the desire to invest, simply because, I was an equity investor in my own company. The company, the company which I was running, or I was setting up, or I was busy doing things, was a cash guzzler. You needed to buy a fax machine. You needed to buy a printer, or you needed to upgrade your PC from 286 to 386 to Pentium. So those were my big cost, and then you needed to buy a scooter and then a car. So it was almost like a household being run, but it has turned out to be okay. The equity investment in value research has turned out to be very nice, because I never borrowed money and I never took any equity. Not that it was available. Those were days, where nobody will lend you money if you don't have a collateral. And
would you IPO it, Dwayne?
Huh?
Would you go for an IPO of value research?
No. I might, if I come across an opportunity whereby I can make a big difference to people, and capital will help, by all means. But right now, I've run it so conservatively, and my essential needs of running and growing the business, that is not getting stuck. We are a very cash-rich company with our modest earnings. And I still run the business in a manner that, every month I try to be viable and profitable. And so I don't have a need to, but I'm not very averse to it.
Sorry, so your portfolio?
Yeah, so portfolio, the first 5-7 years, nothing happened. Then I started investing entirely into mutual fund, and for a very simple reason. Not that, because value research started as an equity research company, and then we pivoted into mutual funds simply because there was no business model that can support equity research unless you become a broker. And so that is how we got focused on mutual fund. And then mutual fund gave you a great opportunity to invest in a diversified portfolio run by a fund manager, managed by a fund manager, and you could be busy running your business, because I was too busy running my business. Until 2007, when we launched Value Research Stock Advisor, I have only been invested in...
17.
Sorry? Yeah, 2017, sorry. Yeah.
I was hired for Stock Advisor, so I know that date.
Yeah, he was hired for that. And when we launched Value Research Stock Advisor, we made a policy that we will be disclosing all our holdings for our subscribers. So I made it mandatory for everyone. And when it came to my disclosure, I had none. I had some, which was my inheritance, and before my applying for the license, I thought that let me get rid of it so that we can. So I sold off some of the things which I had inherited from my mom and my She has gifted me and my grandparents. So the result was that many subscribers came on board. In fact, 10,000 of them in first few months, and they all said that this idiot is asking to manage, make recommendation, and doesn't invest himself. So that is the time when I actually, formulated a policy that I will be investing my incremental money into equity portfolio in the recommendations that we invest. And not only that, I will be moving 25% of my financial net worth into stock portfolio in the next 4 years. So as a result of which, now I am substantially into equities myself. And the strategy remains by and large the same: buy and hold and maybe sleep. The recommendation mechanism that we have followed in Stock Advisor has not prompted me to do a very active churn, and we have been very lucky so far. And in the last 7-8 years, I've been able to generate about 15-18% more than the mutual fund portfolio. So that is a very fortunate thing.
15-18% more than
the mutual fund gains. And in value search Stock Advisor portfolio, you can actually compare both of them alongside.
So Dhiren, can you give us the current equity, debt, gold breakup in your overall portfolio? Everything mutual fund, stock combined?
My mutual fund allocation is about 25%, 75% equity, and equity is spread over something like 35 stocks. No, maybe about, what I have done is, I made a promise to my subscribers that I'll be investing 2 lakh rupees in every fund, every stock that we recommend. And the SEBI laws actually mandates that I can't invest in any stock before I recommend. I have to buy it after, 30 days and 30 days before, so we don't buy anything before we recommend. But after 10 days or 7-8 days after we recommend, we can buy it. So what I did was, I make that investment, but my equity portfolio is very concentrated in about 20 stocks of the 35-40 recommendations that we have made. But I have small investment in all others, and remaining money is in mutual fund. But there is something, unusual, and I have just been lucky. I was very convinced of this NASDAQ 100, investing abroad, technology. And, I have been a technology, I owe my existence, to the technology leaps that I have witnessed. The biggest advantage I had in 1990 was that I had a 286 while everybody had a typewriter. Then I was able to use Excel while everybody was using Lotus 123. Being little ahead gives you an advantage. You might ask that what is the advantage of Lotus and Excel 123 in 1992? There's a huge advantage, which is when you use Lotus 123 and you process data, to print it for ready to print state, you have to take it to something, PageMaker or something to process it, design it, do the typesetting. Here, you can actually do the typesetting alongside. And that is what led to creation of the mutual fund scorecard, which you see in Mutual Fund Insight even today. That is the first cut design which appeared in Economic Times in 1993. So a good part of my personal investment through mutual fund, which I don't intend to sell and I don't intend to migrate, is in FANG Plus.
Right. But Dhiren, could you just give us a rough breakup, equity, debt, gold, and then international, how much?
International is nearly 25%, and 5% is residual equity, which is in tax saving fund with the lock-ins, and rest of it is equity. And no debt and no gold.
So,
I have some real estate. Earlier I had none. I have 6 offices in Chitrvihar, where, you came after we shifted from Chitrvihar. So we still own that entirely because we can't sell them. They're not sellable. But we were using it, and we used it for 20 years. So we accidentally landed up with a real estate which we can't get rid of or wriggle ourselves out of it.
If anyone wants to buy it.
Huh?
If anyone wants to buy
No, I don't know. Real estate in the changed world, I really wonder why somebody will go for a commercial space which is dead. Yeah, it could be, used for some kitchen or something. There's
25% global exposure is of the total 100% or of the total 25% which you have in mutual funds?
no, it's of my total money.
Total money.
Total money, about 35% is in mutual fund, of which,
of the 35%, 25% is into
25% of my total money is in this international fund. And I don't have real estate. I have, a lot of my ancestral things which my cousins and all keep selling. And they give me some cash every now and then. And yeah, so, they are, and I have one house now. And everybody used to tell me in my family, I never had a desire to actually have a house for a very different thinking. I've always lived in a very lavish house, which virtually cost nothing in relation to its price. So I live in a fancy house which has a lift. And,
so just to clarify, Dhiren rented his primary residence for many, many years.
Even now I live in the rented house.
Yeah.
I have a house. And everybody, in my family, that if you're doing well in life, you must have a house. So I went about buying an apartment. And as usual, the guy actually just took the money, never delivered it on time. 10, 12 years later, he delivered it. Now we have got it ready and using it as an office guest house. But so it's a fallback. But I've lived in a very fancy house. And my circumstances have changed very dramatically. Initially, I was a student, then I got married, then my sisters came and lived with me, now my parents live with me. So this kind of dramatic shift can happen in your lifestyle. And then I will be getting to a stage where I would like to live in a 2-bedroom house, which is very easy to manage. And this is what, it'll give me all the flexibility. You must have money. You may not necessarily have a home. But I am not disputing that somebody has a desire to have a home and he thinks that is real and everything else could be unreal. So I really don't want to debate and argue about that. That is how I am. I can do without having my own home. But incidentally, there's all this ancestral property which my family members, many of you will be facing the same thing. That you have a landed property and things, inheritance which you can't take care of, and somebody is, more so if it is in Bihar, people, encroach. So I've been getting that. So now I have got some, fanciful place near Noida where we have, a big, orchard and things like that. But it's not a very valuable thing. Yeah.
All right.
Now I think, now my need has changed a little bit. There is one thing which has crossed my mind, that why I should have a house. That when you are getting about 50 years of age and crossing it, I've been very lucky with my landlords. None of my landlord ever wanted me to get away. And for that also I followed 2 very simple rules. That with all my landlord, I enforced something in the contract that I will revise your rent by 15% every 3 years or 5% every year. So that actually took care of, the market alignment. The second rule, so give him money on time, on 1st of every month. That's one. Second was that never get into unnecessary argument that, मेरा geyser का switch खराब हो गया बदल दीजिए. That is what a very well-off, he gets completely pissed off with that, what am I doing? So I never always got my fan fixed or this fixed or, never bothered about geyser or this thing or that thing, never let the small stuff come in the way. So that is why most landlords liked me. But, now I think that when you cross 50, you may not be very pleased with the idea when your landlord tells you get off from here. So might have a fallback. So.
All right. Last question from me. Already you guys are asking questions, so I'm not going to take up your time. Which is, do you regret the call on gold?
Not at all. Not at all. There are a lot of things which happens, which I lost. I've missed the, Delhi's real estate boom. I've missed so many things. But, if you actually look at what you have missed, you'll never. I still feel that, my long-term return on equity investment will still beat gold, despite taking the last year's gain.
Over to you guys. Gift City. Yeah, Gift City, but why don't you guys ask it? Because there's a hand up. Neil, pass the mic.
Hello, sir. Sir, I was recently, a couple of weeks back in Gift City, exploring what really it is and what are the opportunities here. But I still couldn't sense and was confident for my investors to, invest out of India. And you sort of confirmed it in your initial address that there's still no practical way out. So what are your comments on the Gift City route that has been opened? And I think it is good, but still maybe a little far from, ready for investments yet.
I agree. And, it's the design of it. How routinized way you will be able to deal with it. The way, I really love this whole mechanism that you write a check and invest in a fund just the way you do any other fund, and your money gets invested in those FANG plus 10 stocks, as compared to remitting this money, taking it back, going to an entity, choosing where to, and I strongly believe that, getting a visibility of what is happening to your money at any stage of time, at any point of time, is a very crucial thing. Right. And unless we get to a point where investing through Gift City attains that level of visibility, it is legitimate. There is absolutely no ambiguity about it. But we have to see that, how the brokers come up, how the money remittance, how it becomes more efficient. Those things are yet to be. So, it's almost like everything is there, theoretically, and we have to see how it gets operational. In fact, domestic mutual fund, it has taken 20 years to get operationalized. Where you can actually, if you are a person sitting here, and I can take you out in the lobby and get you initiated into investing in mutual fund in 15 minutes. And so much of ecosystem is needed. You need the Aadhaar card, you need the online banking, you need the many other things. I remember, I'll just tell you one interesting story. There was this mutual fund company which started, and they had a series of funds, and LIC mutual fund, and they launched a fund, and there was this big crisis. And in those days, SEBI never used to tell that what the crisis is, what the problem is. They used to keep it more so if it is, UTI or LIC. The UTI and SEBI problem never, came in the newspaper till it actually boiled to a point of, too big to hide. But in this case, what happened was a fund company launched a fund called Dhanvarsha or something. It was so successful around 1993-92 that it got some similar, like 800,000 crore from 100 other centers, and the fund company could not collect money from these upcountry centers, 50% of the money, because we think that mutual fund is a given thing. We see that the money we transfer and it gets there, and you can see the UTR number, and next morning, and you can fight with the fund company that my money got there and why haven't you given yesterday's NAV? No, it used to be, in Delhi, the clearing center, bank clearing mechanism was that different markets, different places, different locality of the city will actually close on different days of the market, of the week. So if you are from Lakshmi Nagar, or if you are from Lodi Road, this will close on Monday, that will close on. So, those clearing will actually be settled based on that. That was one of the big revolution of the clearing system, that it all got standardized. And then now we have RTGS. So if you look at what the evolution of the ecosystem, that takes much longer than we think it will. We think that the law has been made and it will all happen. Maybe it will not take 10 years, it will not take 15 years, but I'm talking of, all these. I remember my first SIP, where I could not do my first SIP for more than 1 year simply because they wanted post-dated checks. And post-dated checks, and everybody will be very scared of giving post-dated checks because the general thing was that, the check bounces, then there will be a default and penalty. People don't understand that, here is a debt obligation is very different from your investment being made. It's not violating an obligation. So it's still, some time when it actually becomes mainstream.
Hi.
And
Sorry, I think you had the mic.
thank you so much, Dhirendra, for enlightening, and sharing your candid views about global investing. My question is in two parts. One, just like for Indian stock markets, we have some parameters, like the company should have good governance, zero debt. For the global investing also, could you, throw some light which countries to, look at in terms of certain parameters? Like for example, if US is a large cap stock, you mentioned India being a small cap stock. And in the presentation, if I saw in 2025, I think European countries give the maximum returns, DAX and all, I guess, right? So if you could, share some parameters, which countries we should consider on what basis, right? And maybe if you could outline which countries are best and maybe in the descending order.
I really haven't thought about, looking at geography and the promising part of it. But I have looked at, the US market with great curiosity. I've experienced the product and services which makes it very compelling. I also find that many of these companies have a scale and a technology advantage, which is very much rooted in the ecosystem and their ability to attract and retain those people and keep doing it globally. Other geographies I don't know, but when it comes to specific companies, I don't think those principles are any different. High quality company, which must get demonstrated in the numbers. And so you have the quality parameters, return on equity, return on invested capital and things like that, and consistently over a period of time. Growth, without that, nothing works. Then comes valuation. And all these things combined together, you should know more. The only problem is that, we may not have the feel and touch of, the neighborhood experience, a lot of things that you are able to absorb, or the cultural aspect, which might be very significant. Or many a times I come across some Japanese companies, the way they are configured, the way the cross-holding, and the way they conduct themselves, the value system. I will be very suspicious of a company's financial structure if it is in India. But if it is in Japan, it's considered to be mainstream. So there are a lot of cultural things, which might be very difficult to appreciate. And that, I think, will make equity exploration and research far more interesting. But it'll be a good thing for, good food for thought for me to look at how to look at economies in terms of its, medium-term return potential. And can we really explore such avenues to bring some framework to it? I haven't thought about it yet.
Thank you.
Sounds good. Hi. So here's my question. So with your learnings over the years around international investing, what would be the key learnings that you've had in terms of your own experience? And from what I've been trying to read across international investing. So there are things like organization safety, like how stable is it, how is it performing? Like, I'm not going to give a name call, but a certain EV maker, what happened with them, or simple things like LRS. So I've been personally struggling with getting the right remittance fees with every organization, with who is going to be their nostro and how much are they going to charge, or things like broker terms and conditions. So also read through some broker terms that are still working in the old ways, where they can actually sell off your equity abroad if they need to. So based on those kind of, these are some examples that I've given. But
so if you permit me, I'll answer the second question, which is procedural, and Dhirendra can answer the first on how framework wise.
So over the years is what? Somebody who's looking to start?
No, those things are very crucial, and that is what actually makes these domestic mutual fund really a breeze, you know. You just invest, and not only that, to be able to get, you know, hold that guy with on his collar, that, you know, because SEBI will get hold of them. That actually is another layer of, you know, regulatory, you know, comfort which I will derive. About this framework, you know, I'm not very knowledgeable about it. I just know principally that one should invest abroad to de-risk oneself. I was extremely convinced of this NASDAQ and FANG Plus. FANG Plus, very much so. It's an extremely volatile vehicle. It's very usual for that fund to go up by 2-3% every day, plus minus 2-3%, which will look like a. That is because of concentration. That is also because, and most of the volatility is derived in this fund from Tesla, nothing else, one stock. So if you really understand this, that's all there to it. The risk is, you know, the biggest risk of any investment is not knowing what it is. And that is something. So I really don't know about, I haven't ventured into any other part simply because I don't know much about it. This is one part, you know, where I am actually exposed to all the 10 companies. 7 of the 10 companies, I'm a customer of that. And I'm a very early customer of each of it. You know, whether it be using Google AdSense on value research online in, you know, something like 2004. In fact, that we were the early, you know, riders of Google AdSense. So what happened was, you know, value research was a tiny website, and we had a very loyal follower of about 100,000 people. And Google AdSense started, and we integrated Google AdSense, and, you know, the ads appeared. Our first year earning from Google was $20,000. That was magic for us. We had never made that kind of money. And that carried on for another 2 years. Because, you know, we had a valuable audience, but we never had the wherewithal to have a sales force to go and sell that thing. And we were too irrelevant for anybody else. But so it was, then that was my first understanding of a marketplace where, you know, and initial few years I had no idea that, you know, Google takes 35% of it. It was giving me money which I had never imagined. So when I actually talk about these 10 stocks, of which 7 we are exposed to, it's because, you know, the server that we are using, or the Cloudflare, which is, you know, the interim, you know, mechanism that we use. So it is basically our experience with these services and products. We ourselves venturing into the AI for our own, you know, model, developing that and looking at, you know, we run our own servers, and looking at those avenues and the business model of that. And so you get an opportunity to appreciate many of these businesses. The NVIDIA, you will never figure out otherwise. They are not consumer business per se. And of course, you know, Apple and Microsoft is way too easy to understand. So I just got into something I knew with my eyes open, and I got lucky too.
So I'll give you a bit of history of international investing through the LRS route. So I think the original player in India for more than, or maybe even 10 years is Interactive Brokers. So it's a US broker that's been in India for a long, long time. And in 2019, the first few fintechs came in. So Stockle and Vested launched operations then. And they did really well in 2021, that whole tech boom. And now the field has further broadened. So now we have Zinc Money, we have Appreciate. More people have come in. This is a growing area. And I think Gift City is slowly pushing this forward, and at some point it will galvanize the whole thing. Now you're right about all of the charges, the Forex charges, the compliance with LRS, and we'll talk about it in the Zinc session, but just a quick overview. So a lot of these fintechs have tried to solve for the Forex charges through these bank tie-ups. So basically, if you go through them, you get charged lesser amounts, both inward and outward, and we've done a story on this, we've documented this in Mint. On the compliance bit as well, because they are Indian fintechs, they know our laws, they give you a lot of useful things, like a tax report at the end of the year with all of the currencies converted into INR. So you can just take from that and fill up Schedule FA. And I'm sure they'll talk about it more. But I think it's slowly getting easier both from the government budget side and from the market side. All right, here.
So, Dhirendra, I had a question regarding the future of this mutual fund industry. So, with the advent of SIFs and a lot more entrants, so like, do these entrants have any potential to bring in new stuff or just more confusion for an investor?
No, everybody has been a full service mutual fund in India so far. Everybody starts from liquid fund, goes up to all kind of exotic things. Now there are some fund companies which are starting from the premise that they are index fund believers. They think that they can't differentiate. They think that, then there are, all the traditional ones, they continue. And my sense is that, whatever be the case, there is a big population which is completely unaddressed. I think you don't need as many mutual fund companies, but you can't prevent, more the better, because the kind of competition drives all kind of innovation, the kind of cost competitiveness, and the kind of scale. And the way investors are getting served will also change. I think, more than the fund companies, the biggest innovation or, the biggest enabler of access to mutual fund for investors are these fintechs. Distribution and that getting democratized and that getting enabled. Also, there are a lot of people who still need handholding because money is an issue where, you are still thinking that, is it good enough? Where does my money disappear? It gets debited from my bank account and does not get credited till you get the account statement. That anxiety itself could be killing. More so for a person who is, everybody is there to, steal your money. So in that case, the initial years are very difficult, onboarding and getting the confidence. So I'm not looking at any big innovation. But one good thing that I see is that, if you have 10 players, 1 or 2 will come and actually set the tone. Parag Parikh is one such thing. Quantum tried long time back. It did not really, prove something meaningful. Quant is, but it's up to you to take what quant is. But in a sense that it definitely is trying out different things. Otherwise, we have too much of the same thing. SIF is interesting, and I don't know how it takes off, but I think for most people, there's 5,000, 10,000. That is the reason for existence of these mutual funds, enabling a common guy. And the beauty of this is, it works the same principles. I actually advise some very big investors, institutional investors, and we have also in the past run some fund of some international entities. They were pretty big, some $300, $500 million fund of funds. They closed down after 2008. But when India was the top flavor for the foreigners. But what I find is that I have, by fund selection and some very simple principle, rudimentary principle, I would say, having this belief in diversification, actively managed portfolios, being methodical about it, you are able to beat most other alternative vehicles. I really like the transparency, the disclosure, the regulatory oversight. When you even think of PMS, the biggest gap is transparency and the way they charge, the way it changes. SIF is going to be one, lot of times, the moment everybody wants to be treated in a privileged manner. That's a desire. And that is a trap. So once it gets proven, go for it. Let them prove it.
Can I ask one follow-up question?
So if you're okay with, I'll just add my 2 cents on SIF. There are two places where SIFs have a tax advantage, at least a tax advantage. So, no, SIF. Yeah, so SIF to,
PMS.
no, to AIF rather. So what SIF allows is long short strategies. You go long some sectors, you short other sectors. So earlier this was done in AIF format. Now CAT3 AIF, which is the existing vehicle for it, has a horrible taxation. Like, it's not even clear, are they determinate trusts, indeterminate trusts, how should they be taxed? They deduct tax at 39%. It's terrible. And we wrote about it, you can game the system as well. So SIF presumably will be under mutual fund taxation, which is LTCG after 1 year, 12.5%, which is fantastic. The other product that will probably come back through SIF format is structured product. So some of you might remember MLD structured products where your capital was protected but you got some upside. Again, more tax efficient. That the finance minister got rid of that tax arbitrage in I think 2 budgets earlier. Now it might come back through SIF. So there's a tax argument for it.
So my last question was, how does one optimize mutual fund portfolio? Like, I've never understood that, because is it like just past performance? How can I optimize the mutual fund portfolio apart from selection of strategy? Are there any other ways?
Don't optimize. Keep it simple. There's a great value in simplicity, because when I come across mutual fund collection, people don't look like investors. They look like collectors. 5, 10, 15, having insignificant position, not interested, goes down, you feel sad, but you say, hey, it's very tiny. If it does well, it does not have a meaningful impact. Keep it simple, have it meaningful, have your selection principles which are fairly straightforward. You can write it yourself, you can tell it to your wife. 5-year alpha must, end of the story. Diversified. If you just have these 2 principles, you will have 5 categories to choose from. The value, large and mid, flexi cap, multi cap. I'm just thinking that it must be rooted in your thought process. And it should be translated into some numbers, which you are able to enforce with some discipline. And if you are able to do that, and by virtue of this particular principle itself, 3-year beating benchmark, 5-year beating benchmark, and these broad categories, you end up only with 4 funds. So it's really, it looks simple. It actually is extremely sophisticated. But everybody will come and give you a different story. And it benefits them. So.
All right, we'll take the last question in the meantime, if you guys want to set up for the next session. So all of your technical queries on Zinc, you can address them in the next session. So one last, okay, I think we're out of time, unfortunately. Dhirendra's going to probably be here for a while. For a short while. So you can catch him and ask him offline also. Thank you so much, Dhirendra.
Thank you. Thank you.
All right, so next up, we have Piyush Gupta, who is the CTO and co-founder at Zinc Money. So Zinc is one of these fintechs that are innovating on the global investing space. And one of their really big focus areas is education, foreign education, which is a big ticket item for most of us, many Indian families. So without further ado, he's just going to connect to us.
Hi everyone. I hope you are able to hear me.
Hi, Piyush.
Hey, Neil, are you able to hear me?
Yes, we can hear you.
Right. So first of all, apologies especially to Neil, Roche, and everybody else in the Mint team, along with everybody else who's present there. Unfortunately, because of a lot of flight schedule changes over the last couple of days, I've not been able to make it in person. I was really looking forward to doing this in person. Uh, Secondly, I've been listening to Dhiren talk about this for last 30 minutes or so, and I'm realizing that it would have been a great thing if we would have had an Oxford style debate where a for and against for international investing. I understand and I really respect the kind of knowledge and the wisdom that he brings into this mix over the past 35 years of his investing experience. But I probably will take a foresight against it, which is that, hey, why international investing is important and how how it can impact you and your portfolios, your investment strategies, and the final outcomes that you're looking for. Um, uh, so without delay, maybe I will just give you a brief overview of Zinc as such. So we started Zinc last year, and we started Zinc effectively with one mission. At this point in time, the mission that we're looking for is that higher education is a very big component of a modern parent's life for the child. And a lot of us, probably including myself and a lot of the people in the audience, will end up sending their kids overseas for education, whether that's for an undergrad or whether that's for a postgrad or or a PhD or anything of that sort. And this is because of a few reasons, right? Like if you look at the number of graduates that we have every year from 12th standard compared to the number of quality seats that are available, that's reducing. The difference between the cost in Indian education and higher education is also sort of reducing a little bit. Like when I went to UIUC in 2009, different, and I went to Pilani for my undergrad. Like it used to cost me 20,000 rupees a semester. I don't think there is any college right now in India for engineering that costs 20,000 rupees a semester. And UIUC used to cost $38,000. In 15 years, UIUC has gone from $38,000 to $45,000 or $46,000, but Pilani has gone from 20,000 to effectively 2 lakhs. And this difference will effectively keep reducing because INR will keep depreciating. We will have we have higher inflation, so the cost will keep increasing at a faster pace, and the inflation specifically in education sector is much harder. Now, if you are gonna spend in dollars for your kids, and about 1 million kids went last year, but if you're gonna spend in dollars, or if you're gonna spend in euros, or if you're gonna spend in a global reserve currency for your kids, it makes logical sense to sort of de-risk yourself by saving in that currency. Now, it is possible that from a quote-unquote weather versus climate pattern that money goes up or INR goes up and INR goes down. But the general interest parity theory and general trend would say that INR would depreciate in the long term over global reserve currencies, just because we have a different interest rate and repo rate compared to, let's say, what a Fed has. And that 2-3% difference, along with the deficit that we have in import-export, actually makes this worse. So Zinc effectively solves the higher education conundrum and higher education problem for your kids end to end. So we look at a solution from financial stability point of view to be able to give you portfolios that are internationally curated, that are curated by our partners, Rio Wealth. They are a boutique specialized investment firm out of Hong Kong, Singapore, US, Dallas, Texas, Houston, everywhere else. And they manage about $5 billion of AUM. So they are the ones who design a lot of these portfolios. We operate out of Gift City so that you have the comfort of some of the things that Dhiren was talking about and some of the questions that people had. We don't have any of these archaic laws where we are able to sell your securities without your consent for any order. It would effectively work like how Indian brokerages work. But the way we look at it is that we are effectively providing you a structure for your child to be able to get into the right set of universities from an academic and an admissions point of view, and a structure for you to be able to save or borrow that money for your for your children when the time comes. I have two. I have one 3-year-old and one 10-month-old child, and I'm effectively looking to create a structure in my own head to be able to send them if the need arises at that point in time to US. And I think that's where Zinc Money's unique proposition sort of comes together.
Frequently asked questions that you guys get. I'm going to throw it open after that to the audience. I'm going to keep it very brief on my part of it. So first of all, how are you regulated? By whom are you regulated?
Sure. So we are regulated. So we have actually many licenses. We have a license for registered investment advisory in India, and that is regulated through SEBI. We have 3 additional licenses, which is the payment service provider license in GIFT City, a broker dealer license again in GIFT City, and a financial company license, which is effectively an equivalent of an NBFC license in GIFT City. And for all of these, we are regulated through IFSCA. And IFSCA has effectively the same amount of powers that a SEBI and an RBI has for that particular SEZ. So from a regulation point of view, we are equally regulated as any of the Indian mutual funds or any of the Indian payment service providers or any of the Indian NBFCs.
All right. How much does it cost to transfer money abroad and back through you guys?
So I think this is one of the things that you had touched upon in the past, in the previous session. So we have vertical integrations with banks. So effectively, what we have done is we understand that LRS is an extremely complicated process, not just from a financial burden point of view or an entry load point of view, but from a point of view of just executing it. Like, you're not able to transfer money that seamlessly, even though you may have transferred it in the past from the same bank. So what we have done is we have effectively integrated our value chain with an 81 bank and an 82 partner throughout. So you are able to transfer your money from your Indian bank account using a simple UPI or a NEFT or an RTGS, and that money gets transferred, and you get favorable rates because of this. You get favorable rates on the order of being like, so like if you transfer to an HDFC today, that might look like a 2%, 2.5% sometimes markup plus a very, very large amount of fixed fees. For us, the fixed fees will also be much lower, and the markup would also be less than half of that.
So can you give us some numbers in terms of fixed fee and percent?
So the fixed fee for us right now is somewhere between 300 to 500 rupees, depending on the transaction size, and again, depending on the transaction size and the bank that you have, the markup can range anywhere between 50 cents to about $1, like a 50 bips to 100 bips.
Okay, so let's say 1% on the higher side and 500 rupees as your fixed fee.
Yes.
Okay. Sure. One second, we'll just pass the mic.
So if today I had to send 1 lakh rupees and just get it back without doing any transaction, how much would I be getting back? So if I just sent 1 lakh, converted in dollar and just got it back. Just for illustration, like.
Sure. So if you want to just basically send the money and bring it back, so you are effectively now doing transactions both from India to a dollar account or to a whatever dollar entity, and then bringing it back. You are basically getting charged a couple of times. You would be getting somewhere around 98K back.
Yeah, 2,000 rupees gone in. But the argument, the counter to this is that if the rupee depreciates by 4% a year roughly, then you're more cancelling.
And the argument for this also is this, right? Like, you're not looking for some of these things to be extremely short term. You're not looking for this to be that, hey, I want to bring my money back every month, or like even when you have short-term strategies, you can keep your money outside. You don't bring it back every month or so. So when you look at it from a XIRR or an overall perspective of a 3-year or a 5-year things that like Dhirendra was talking about, this number starts looking much smaller. So it may look much higher at the beginning as an entry load, and that's true. There is no denying that. But the access to those things effectively cost us that.
All right, Piyush. Yeah.
Sorry, go ahead.
Could you talk about a UCITS ETF, because a lot of concern is around withholding tax and inheritance tax. Somehow nobody raised that point yet, but that always gets raised. So could you mention both?
Yes. So I think that's a very good point. So this actually becomes like a big problem for a lot of investors going forward, right? So in US, all ETFs are effectively distributing ETFs. So anytime a dividend is paid out, it will be given to you. So you will be taxed on top of that based on your income slab. On top of it, there is a withholding tax, which is 30%, which is applied on this paid dividend. And again, as Dhiren mentioned, the tax laws are not favorable to be able to get that credit and get that credit again against your Indian taxes. Versus, and the second big problem is that in US, you have a limit of $60,000, above which you are irrespective of whether you're a citizen or not, irrespective of whether you're a resident or not. Estate tax is a very big thing, and estate tax can go up to 40%. So let's say you have $100,000. On that $100,000, the $100,000 portfolio in US, and this can be a simple portfolio. It can be an S&P, it can be all in Nvidia, it can be all in Apple, it can be all in Tesla. But that $40,000, in case of any incident in India, you would be taxed 40% on top of it. So that becomes a very, very big concern. Versus a UCITS ETF, where the withholding tax is not there, where the withholding tax is much smaller, because these things are domiciled in Ireland. And secondly, there is no concept of estate tax. So the $100,000 that you have, in case of anything that happens wrong here, you would still be able to get it back for your nominee or for yourself, depending on how you have set it up. Now, one thing that I wanted to sort of mention here is this, that I understand that there is a lot of comfort that we can derive from the fact that we are in India and the SEBI is in India, so somebody can sort of grab a collar in India, and this was a point I think that was made. But if you look at the framework in general, and I'm not saying that there would be a one-to-one comparison this way, but if you look at the frameworks, usually EU is always most consumer friendly. They are always hardest on companies. They always have the stringent frameworks for any of these things. Like whether you look at data protection, whether compared to a GDPR versus a DPDP, whether you look at consumer protection in EU versus India, whether you look at governance of companies in EU versus India. Similarly, UCITS is a framework that's applicable to all EU members. So UCITS framework is extremely stringent. And I can tell you this because we have developed a ETF, and I think we are probably one of the first ones to do this in partnership with Leo Wealth and Waystone, who's the provider, which is called GIFT-LN. It's a global target savings 2031 to 2034 ETF. And we have gone through each and every single point in terms of what are the compliance requirements that are there, along with what are the key information documents, what are the PRIPs, what are the KID, and everything else that you would require. If you were to go onto a mutual fund website, it is possible that you don't get the most latest information, but that can never happen in a UCITS framework because UCITS framework are generally a lot more strong. I would give that point that although that because you are still investing outside, that there might be some anxiety that gets revealed by the fact that you are in India and SEBI is in India. That much I would definitely concede. But from a safety point of view, from a compliance point of view, I think these things are not where they used to be even 5 years ago. They're much, much, much ahead, and the safety of a consumer is actually much higher now.
Piyush, can you talk about IFSCA and what does PSP license mean? What you have this concept of a wallet in Gift City in dollars. Yeah.
So again, as I said, so because we are an end-to-end solution effectively for higher education, and that's our current focus, there are a few things that we are looking for when you're looking for higher education. And this is how we have sort of gone after the licenses and the way that we have set it up. So one of the biggest things is obviously a broker-dealer license and structured products within those broker-dealer license to be able to reach the goal that you want to reach to. Like, I don't want to end up in a situation, let's say, where my kid was supposed to go into college in 2009 and I was invested in market in 2008 and the money that I had dropped by 50%. So the structured products effectively take you from high in equities before so that you can get the growth, but low on risk as you get closer and closer to your goal. The second big thing that we are looking for from a higher education perspective as your kid goes out, and there's a lot of anxiety on that, is being able to transact, being able to hold a multi-currency or a dollar account before you go there. Now, in most universities, what ends up happening is once you reach there in about 10 to 15 days, or even longer, for some cases, about 6 months to a year, you would be able to get a card. You would be able to get an account and use that account for your daily uses. Given that we have a payment service provider license in Gift City, it effectively gives you a multi-currency account. It gives you an account where you can hold your money in dollars, where you can hold your money in euros, where you can hold your money in an Australian dollar or a Singapore dollar or any other currencies. And this is an account that you can actually have before you leave India. So the concept of e-wallet is that it's not really like a full-fledged account because it's still a payment service provider account, but it allows you to be able for you to hold money, and it has effectively all features of an account. You're able to transfer money, you're able to use a card on top of that account, and so on and so forth. So that's where PSP comes into play. And I think you can also now think of, I think there was a question, the earlier question about, entry and exit. Like every time the money, if you want to do any short-term strategies, if you want to do like short-term plays, if you want to do anything else according to that, you would be able to hold your money there. You would be able to hold your money in the e-wallet. You don't need to bring it back to India. So there's no entry load or exit load every time you have a change in strategy. You would be able to hold your money for about up to 180 days there.
All right. I will open it up now to you guys. Any questions? Yep, go ahead. One sec, just the mic. They'll just get the mic.
I read your website. You did mention about having the education financing player as well, where the dollar disbursement happens.
Sure.
Could you please elaborate a bit there?
Sure. As I was saying, because our primary focus is on parents who are looking to send their child abroad, and as you're looking to finance these education can cost anywhere between $50,000 to $400,000 for 4 years. You may have a portfolio, you may even actually have a decent amount of money, but there are possibilities that you don't want to actually liquidate all your portfolio to be able to fund this. So, or you may require gap funding. And for that, we are able to disburse dollar loans to you. So these loans are again out of GIFT City. They're denominated in dollars. So you would effectively get like a $30,000, $40,000, $100,000 loan. And you would be able to use it like any other education loan. And this is again, if you think of it from that perspective, our primary objective at this point in time is for serving for all use cases for higher education to make sure that you are able to afford that higher education if you want for a child. So we help you to save to get there, but if you're not able to get there, then we provide these dollar loans for your funding.
And this is largely through your partners, not like you did mention about Zinc, NBFC, something as well.
So we have our own. We have our own financial company. So we do provide this on our own, along with the partners that we are partnered with. So something like so we do have partners in India, along with some partners where we have raised debt from. So we do have our own financial company from which we can provide loans.
So it's not called an NBFC in GIFT City, it's called something else, right?
It's called a financial company. It's called
I mean, you will take the exposure on your books. Like saying, I would be borrowing from you, not. You got it. Thank you.
So you will be borrowing from us.
All right.
Question back here. Hi Piyush. Quick one on can you throw a little more light on the actual process of the corpus building side, including like investment strategies and what flexibilities may be available, right? Like risk appetites could differ, like across. Yeah, thanks.
Okay. So actually that's a very good question. And as I was saying, so what we have done is that we have worked with a lot of partners and more specifically with Leo Wealth, where we have developed these very specific portfolios. Now, let's take an example. Let's say that your child is going, there are two personas. Let's say there's a parent whose child is going in 2028 versus there's a parent whose child is going in 2038. Now, for the child who's going in 2038, and as Dhirendra would tell you that, usually in long-term equities provide a lot more growth. Like I'm not looking at the daily disturbances that are there going there in terms of volatility. Like I'm not worried about if things go down by 10%, that doesn't like create any amount of panic in me because I'm still like 10 years away effectively. But for somebody who's going in 2028, you still want to be risk averse. And on top of that, you have your own risk aversion. Like you can still be an aggressive investor, but you still want to be risk averse for 2028 to ensure that you still have a lot of capital protection. So in this case, what would happen is that we would have one of the portfolios depending on when your child is going and what your risk level is. So let's say if you're going in 2028 and you are a moderately aggressive investor, then we would have a defined portfolio which will have a glide path at some level to get down to lower and lower and lower risk as you come closer to the admission time as well as the payment time for your child. Now, if you are in 2038, then we might keep your equity much longer. We might keep you like a fully equity portfolio, like say 10 years, 12 years, even 10 years for now. And then starting maybe 2032, 2034, we will start reducing down equity to debt so that your risk reduces by the time you reach 2038. But for 2028, this glide path looks very, very different. Now, Sorry, just 1 second. I would take probably one more thing, and this is one of the reasons why, like, if you see, and you're welcome to do your own research on this. Like, the ETF that I was talking about, this is called a Global Target Savings 2031-2034 ETF. This is effectively for parents who are looking to send their children between that time frame. So if your child is effectively going to be there, what you can do is you would be able to have, so the way this works is right now, and this is the ETF, so we had to disclose this. We don't really have a lot of wiggle room in terms of the glide path, but what we have is that this is actively managed. And this is again something that Dhirendra was talking about. So we have about 4 years of 90% equity, 5% long-term debt, 5% commodities, and then that equity graph comes down from 90% to like 10% by the time you hit 2034. And the long-term debt keeps increasing, then it keeps reducing, and the short-term debts keep increasing and keep increasing as you get closer and closer. So the idea is that these are very structured products for your use case, the use case that is your child's education. Now, depending on what you're looking for, like if you're looking to diversify and all of these things, we can have another like much more detailed conversation, and there also we provide a lot of advice.
So I'll just quickly supplement that. The interesting thing about their ETF is it's an ETF. So the rebalancing is happening inside the ETF, so you don't pay any tax. Whereas if you do it yourself, move between funds, you end up paying tax. So that's a bit of tax advantage they've got there. And it's a UCITS ETF, so there are no dividends.
Yes,
so
it's an accumulating ETF.
Sorry?
It's an accumulating ETF, so there are no dividends in between. So your money effectively gets reinvested, so you get much higher returns compared to like a distributing ETF.
All right. Hand there, yep.
Yeah, hi Piyush. I want to understand the platform Zinc Money is only for the people who directly wants to invest for their kids' higher education, or it's also for the financial intermediaries like CFPs or MFDs who handle clients here and are looking to partner or looking for solutions for their clients, apart from the mutual fund options that they have.
So I'll probably take this question with a little bit more nuance. So from a platform perspective, we are a customer-first focused platform. But that doesn't mean that we don't really work with MFPs and others who are intermediaries for their clients to actually provide them solutions. So if you are an intermediary who's looking to ensure that there is a quote-unquote innovative solution for your child, we are more than happy to sort of partner with you and provide it for your clients as well. But from a platform perspective, we are customer focused first. So the customer would be able to see exactly what even if you are doing it on their behalf.
So presently you don't have, but you can, you're open to it.
Yes, we are. So we do work with some MFPs right now, but the way it works is that the MFPs work directly with us to essentially curate the portfolios that they want for their clients.
Thank you.
So they custom design the portfolios for their clients.
Correct.
Okay. Yep, go ahead.
So I was checking out your product Zinc Global. Is it only for education, or like there could be a business or individual personal use case as well? Like I do foreign investment, so
here's the thing. Like so the platform is very much focused on education for now. The reason it is focused on education for now is because I want to be able to provide that level of personalization and focus on a structured product, specifically when you're looking for your child's education. See, when you're thinking of having like a vacation abroad versus a child's education versus buying a house versus a marriage, like your thought process in terms of what is the level of risk that you want to take and what is the level of control that you want to have are actually very, very different. Like there is possibility that you want to put, let's say, 20% of your income into like extremely high alpha generating strategies, but that's not what you will bet your child's future on. And this is how, this is why if you see Zinc Global is primarily focused on this. But once you come to the platform, because we have a full broker-dealer license, you would be able to buy anything that you would want. And we would have curated portfolios even for those cases, where you would be able to buy portfolios that are, like, let's say if you want to buy a sector, like how he was talking about Fan Plus, like if you want to buy a Fan Plus basket, you would be able to buy that. If you want to buy semiconductors, you would be able to buy that. If you want to buy very specific alpha strategies, you would be able to buy that. The one thing that I think doesn't really get talked about a lot, and there's a parallel to something that even Dhirendra was talking about, that simplicity matters a lot. Like I think in most cases, like I think there was this survey a couple of years back where like 87% of fund managers around the world use to indexes. So it's not really that. So there are about 15,000 ETFs that are available, and these ETFs have strategies inbuilt into them, and they're actively managed ETFs, there are passively managed ETFs, there are ETFs that are primarily looking for that are driven by quantitative research, there are ETFs that are driven by value, there are ETFs that are driven by momentum, there are ETFs that are so actively managed that they are effectively called alpha ETFs, and ETFs provide that level of like an extremely high level of cost efficiency compared to you doing this on your own, or even like if a financial advisor or like a PMS would do on their own, just because they are doing everything effectively in the back end, and because they are doing in the back end, they actually have a much bigger corpus, and they're able to take much larger and much smaller bets compared to what an individual would be able to do. So to answer your question in brief, yes, you can use it for any other purpose as well. It's just that when you come to it, the focus on this is specifically for education.
All right, I think one final question, and then we have to move to the last. Yeah, go ahead.
Just one simple question. So I signed up on your app quite a few days back, still waiting to be let in. I'm still in the waiting list. What are the banks that you're tied up, and do you have any other banks, or not just banks, any AD1 or AD2 in line to be tied up with? So the reason I'm asking is primarily for the Forex rates. What I've seen is that some AD1s do better rates than others. And I'm more than happy to pay fixed fees if we get a better rate there that ways.
So one thing that I can definitely say is that you're going to get a better rate, because we do have tie-ups with individual banks who do this. Now, the way we have gone about it is that we have tie-ups with HDFC, we have tie-ups with ICICI, and at this point in time, we have tie-ups with RBL. These are the three banks where we have deep tie-ups. Now, from a coverage point of view, this hopefully covers about 80% of the country, because HDFC and ICICI, most people have one account or the other. It doesn't mean that we are not going to tie up with other providers as well. And these are direct 81 tie-ups, because these are banks who have the ability to transfer money. We do also have 82 tie-ups like Zenith and Ebix Cash and others, where we have 82 tie-ups for very specific use cases, where we want to send money LRS for like a specific university account and all of that. Now, if I wish I was there. If I was there, then I would have asked you your phone number and we would have whitelisted you tomorrow. But if you could send me that number, I would definitely make sure that by tomorrow somebody from my team reaches out to you and do this. Please understand that we are providing like a holistic service. We are providing a service from a perspective of even counseling to students, from a perspective of ability for your child to get into university and you being able to save and borrow both, and to be able to maintain that extremely high premium white glove experience. It's still, everything is still in a waitlist mode. So very few people effectively is the ones where we know that they have the right intent and they have the right strategy to think about is the set of people. I apologize if somebody has not reached out to you, but I'm sure that somebody will reach out to you soon.
All right, Piyush, thank you so much.
Thanks. Thank you.
We will now move to the last panel of the evening. I know some of you might be hungry. We'll have dinner shortly, but I think one big part of global investing is, of course, the geopolitics of it all, and it is now so much in flux with the tariffs, with the Indo-Pak situation, and so on. So to decode that, I'm going to invite my former colleague, Elizabeth Roche, who was earlier the foreign affairs correspondent at Mint. She's now professor at OP Jindal University. Elizabeth, yes. And she will be joined by two very distinguished members of our foreign policy establishment, or people who track what's happening in major global events. So without further ado, Elizabeth.
Hello, good evening. Am I audible? Yes, I guess I am audible. Could I please invite Professor Dr. Mohan Kumar? Please, middle, please. And could I please invite Mr. Srivastava? Okay, before I start, I understand that we are the panel which is standing between you and dinner, so we'll try and make this as interesting as possible. A very short introduction, by no means to take away from the eminence of the two people who are on my panel here. Ambassador Mohan Kumar is a senior colleague of mine at OP Jindal University. I'm sure most of you are aware that it's one of the foremost private universities in the country. Ambassador Kumar was in the Indian Foreign Service for 36 years, and he retired as ambassador to France. He has a lot of experience in dealing with trade issues. In fact, he was one of our negotiators to GATT. GATT, I'm sure you know, is the predecessor of WTO. And he also has dealt with our neighborhood. When I say neighborhood, Sri Lanka, Maldives, Bangladesh, and Myanmar. He used to be the Joint Secretary at one point in time. To his left, if I'm right, is Mr. Srivastava, who used to be with the government. He's also got immense experience in dealing with trade issues. He has set up this advisory group or consultancy group, and he writes in columns in a lot of papers. I'm sure you are aware of the Global Trade Research Initiative. So without much ado, I'm just going to launch into my questions. Ambassador Kumar, if I could speak to you first or ask you first. Trump, in his initial first term in office, which is Trump 1.0, he dealt this body blow to the dispute resolution mechanism of the WTO. Now, in Trump 2.0, he has, by imposing all these tariffs on all these countries, he's actually demolished what WTO stands for. So what do you see coming out of the ashes? Do you see anything at all coming out of the ashes, or is this a whole brave new world for all of us?
So thank you very much, and I want to thank Mint, but most of all I want to thank my colleague, because without Elizabeth I wouldn't be here. So very simply, I think you have to understand what WTO was all about. So if I can spend 2 minutes just saying that it was the embodiment of the multilateral trading system and was based on a concept called Most Favored Nation, MFN, which I'm sure all of you know, more or less. But the fact of the matter is, if you give an MFN tariff to a particular commodity, to a particular country, it has to be made available unconditionally to everybody. And that principle, I think, has gone out of the window. So if I can request yeah, we will eat, but you don't have to yell. Thank you. So I think what President Trump has done essentially is to signal that the most important player will withdraw from the WTO. You're quite right, he dealt a body blow to the dispute settlement. But actually it was Barack Obama who started the whole game by saying, I will not renew the membership of the appellate body. Appellate body is basically the Supreme Court, if you like. The panel level is a stage where I participated in panels, so many of us judge a dispute, and then it goes to the appellate body. So to answer your question, Elizabeth, trade is going to be non-MFN, reciprocal, and strategic. And if I can explain what I mean by those three things. Non-MFN, so basically I'm not obliged to give the kind of outcome that I may have with Trump to others. There's no reason I should do that. I therefore negotiate a deal with Trump or with the United States, as I'm doing now, and that will be applicable only to US and India. Now, it's not as simple as you think, because every country has something like 12,000 tariff lines. Each commodity in the world is actually denoted by an 8-digit number. That's how traders trade with each other. Otherwise, you'll have to go around saying it's a cotton shirt, it's a sleeve shirt, it's a men's shirt. All of this is just 8-digit number. There are about 12,000 to 14,000 tariff lines. So what President Trump has embarked upon, and I'm extremely doubtful whether even the mighty US has the capacity to negotiate with 60 different countries. I'm particularly happy that India has got a first mover's advantage, and hopefully we will get a deal done. But therefore, what President Trump has done is introduce tremendous uncertainty and volatility to an international trading system. It's impossible for a trader now in India to know what the duties are going to be in Vietnam, because again, you see, that depends on what US and Vietnam do, or what the US market is going to be vis-a-vis India. We don't know how European Union is going to do this vis-a-vis America. So all in all, he has brought a wrecking ball to the multilateral trading system based on MFN. So MFN is out. Second, it is based on reciprocity. President Trump has a very simplistic approach to trade. He says, if I am charging 0% on Bajaj scooters coming into the US, why the hell are you charging 150% on Harley Davidson bikes? So bring it down to 0. I'm doing 0, you do 0. I'm able to import apples from India at 0%. Why the hell should India charge 50% customs duty on apples from the US? So his view is that it goes against everything that you have learned, class 101 economics, Ricardo, comparative advantage, Friedman, everything goes out of the window, but that's he. And you have to deal with it. So it's going to become reciprocal. Whatever you give for your market, you give to the others. This is absolutely, frankly, not going to work, because the whole concept of trade is comparative advantage. And every country, if it starts believing in balanced trade, that's a slippery slope. But that's what we are up against. And third, I would say it's also strategic. And what I mean by strategic is everything that you're wearing at this point, including your shoes, your undergarments, your watches, all that is non-strategic. But if you're going to talk semiconductor chips, if you're going to talk photovoltaic cells for solar panels, and if you're going to talk active pharmaceutical ingredients which go into the making of drugs and pharmaceuticals, those are all strategic products. I'm going to conclude, Elizabeth, by saying India missed out on the global value chains. We completely missed out. And that we just basically screwed up. We have an opportunity to get on to the disruption of supply chains and the establishment of what is known as resilient supply chains. This is really, I think, the last opportunity. It's, for me, the Indian economy faces a 1991 moment. It's a do or die affair. I would also conclude by saying Indians are reformers out of compulsion, not out of conviction. It's like getting your daughter married off. You know, everything is a chaos until the last day, but somehow you end up marrying your daughter off with the father getting the heart attack the next day or some such thing. So we are doing the same thing in the context of trade. We will only do with a gun pointed at your head. So in a very perverse way, I think that Trump is doing us a favor so that you can convert this crisis into an opportunity for India. Your tariffs are high. Your foreign direct investment regime needs reform. Your non-tariff barriers regime needs reform. Your labor and land reforms have to be implemented in full. You got the laws, but implementation has not happened. So you use this, you bring your own wrecking ball to your economic regime and just change. That to me is the way out, frankly. There is no point crying and saying, oh my God, what is he doing? We have done that for too long. So I would say that this is a tremendous opportunity. So the 3 FTAs is the wrong word. We are not doing FTAs. I'll come to that later. But the 3 agreements we are doing, US, EU, and UK, which we have just concluded. Fine. That's fantastic, I think, because we have looked east in the past and it has not worked out. So we are looking west. There are reasons for it, but I don't want to monopolize airtime. So basically, I think as Rahm Emanuel, the American politician, once said, never waste a crisis. Just use it as an opportunity to do the things you are otherwise unable to do, because we are incapable of producing a consensus politically. I mean, you look at the farm bills, eminently sensible, but you had a few farmers who just held it hostage. So that's what is going to happen. So don't ask anybody. I was once asking, I will not reveal the names, the chief architects of the 91 regime, and 2 of them were actually Sikhs. So I asked one of them, I'll not tell you who, about how we did all this and what consensus you built. He told to me in chaste Punjabi, Ghanta consensus. We just went ahead and did the damn thing, abolished the license Raj overnight. That's what we should do, I think. I sound like an Ayatollah, but I'll conclude here.
Thank you, sir. Thank you for that. Those very mazedar remarks. Mr. Srivastava, if I could ask you, when Vice President Vance was here, we got to hear that the terms of reference have been agreed to, where the India-US trade agreement is concerned. What does that mean exactly, and where does one go forward from here? Terms of reference means what exactly?
Thanks, Elizabeth. So, when India and European Union, they decided to enter into an FTA back in 2007, terms of references, they were signed between the Prime Minister, Dr. Manmohan Singh, and the European Commission President. And they were out in the public. So we said very clearly that tariff eliminations on up to 90% of the products, they were out in the public, and negotiators must have a copy of that, because then they will know what to negotiate. This time, unfortunately, nothing in the public domain. So Mr. Vance said that he and Prime Minister Modi, they agreed for these things, but what has been agreed is not in the public domain. So nobody knows about this. And without knowing, I think negotiators cannot negotiate. They should have the boundary lines. They don't know the boundary lines. Or I don't know whether they have been shared these things in secret. But secrecy is not possible. These documents have to be in the public domain. It is not in the public domain. So that's where we go. And right now, my sense is that negotiations are happening, not at the technical scale, not at the tariff line wise as they are normally done, but their broader understanding is being done. And if I want to draw parallel, yesterday Mr. Trump has announced a deal with UK. So UK deal is not even 10% done, but they identified certain top items. Okay, I'm cutting tariffs on steel, aluminium, auto, and you cut on these 3,000 items. I'm cutting on 50 items, you cut on 3,000 items, and that's, you buy some more Boeings. And my teams will negotiate for months or years. I think that's the way he has done with the UK. He calls it US first FTA in the Trump 2 scenario. I think the same fate may await us, that we may soon announce a conclusion of the FTA with these top-end things. And rest may take months, years, may happen, may not happen. I'll stop here.
Okay, so my next question before I open it out to the audience is to both gentlemen, actually. So if you could, comment on it. The way Trump has gone about this trade tariff, the imposition of tariffs, it makes China really look good. So is he actually, what is he doing? I mean, I understand with Trump there's sometimes method behind madness, most times there is no method behind, or it's all madness all the time. So how does China, from where I stand or I look at things, China seems to be benefiting a lot from the Trump chaos. Is that the position you hold as well?
No, Elizabeth, not entirely. I think there is a method to whatever you call it. I think President Trump is addressing two things. One, China's share of global manufacturing is 32%, and US share of global manufacturing is 16%. He doesn't like this, and he thinks this should be reversed as quickly as possible. The second is that even GDP, the global share of GDP of the US is 26%, but China's is 19%, it's catching up. So he wants to reverse these two things. Now, there are two ways to reverse it. One, you make manufacturing more competitive. But he thinks the other countries are ripping US off. Right. Now, there is one issue on which he is right, which is that undoubtedly the US is the biggest consumer market in the world, without a question. I think it's bigger than the EU as well. EU comes a close second. So what he's doing is he's dividing the world into China and all the others. I am willing to accept your the contention that you hinted, which is with everybody else, I think he is using it as a negotiating ploy, a bait, if you like, or a gambit, a negotiating gambit. And that's what he did certainly with India. He will try to tell India that, listen, you are a tariff king, you abuse trade, etc., and then try and see if you can conclude a deal. By the way, most of us will agree that India's tariffs are high. So that is not an issue, frankly. Everybody believes that. Question is, which are the industries you want to protect and which not? You can't really go, and that was one of the problems I had as a WTO negotiator in Geneva. If I go to the American negotiator and say, I'm not willing to open up manufacturing because we are uncompetitive, I'm not able to open the legal services industry or the firms in India, we can't open up insurance, we can't open up banking, we can't open up the jute industry, agriculture is sensitive, dairy is sensitive, then the American will say, what the hell are you willing to open up? So what is the leverage that I've got? So that's the issue really. With China, I think he's very clear. He believes that manufacturing must return to America. The question is, by doing tariffs alone, you will achieve the disruption of global value chains for sure. And some things can happen, like the relocation of iPhones to India, for example. More and more iPhones can be made. There are capacity constraints in India, but nevertheless, a lot of production will, I think, shift to India. But there are limits to how soon this can be done. To shift iPhone assembly to Greater Noida in India is possible. But I don't see how suddenly semiconductor chips can be made in Greater Noida instead of Taiwan. You know what I'm saying? That's not possible so soon. You know, it's very hard. And TSMC is investing in Arizona. They're investing in other places, but it's going to be a difficult. I think for President Trump, he has a good understanding, by the way. The economy is stretched and the deficit is too high. He doesn't want to tax everybody, but he wants to give them tax breaks. How the hell do you give tax breaks when your economy is going bust? So he believes tariffs are a way of collecting revenue and that he can use that to give tax breaks. That's what he's going to do. What he's overlooking is, I think, the cost for the average consumer in the US. But then the MAGA crowd being the MAGA crowd, I think they will be able to bear this cost, frankly. We will have to see. I mean, the real test will come when the midterm elections happen. But I think as far as the multilateral trading system and President Trump's approach is concerned, what is interesting, Elizabeth, is that every country is adjusting to it. Yeah. You know, we may call him whatever we want, but the fact of the matter is you don't find too many countries really, except for China, which actually criticized the move. India kept quiet, EU kept quiet, and Singapore, ASEAN has kept quiet. Everybody is falling in line, actually. So I would have to say there's something that he's doing which is actually making all of us react to what he is doing. And therefore, we will have to wait and see how this plays out. The future of the WTO, just 1 minute. Very briefly, WTO is not going anywhere, but I think it will shift from being an exclusively multilateral organization to a plurilateral organization, which means there are 100 countries in the WTO which are willing to negotiate e-commerce, investment, etc. India is not one of them. So basically those 100 countries will get together and say, we are going to negotiate new agreements. If India, South Africa, Indonesia don't want to join, that's your problem. And you join later if you want. But then you would not be within the tent. It's not something I would recommend, but the government of the day will have to take a call on that.
Mr. Srivastava?
So, I think Trump's tactics did not work last time in his first term, and they are not working this time also. I'll just give some data. So the trade war formally started by him in March 2018 when he imposed tariffs on steel, aluminum, and a lot of tariffs on China. So we compared the US imports between 2017 and last year. So US imports from China, they declined by $82 billion. So US say, okay, my restriction on China, they are working. But US global imports during this period, they increased by $760 billion. And half the Chinese exports to US, they were going to US indirectly via Mexico, via Vietnam. And during this period, China's global exports increased by $1 trillion. So US global imports increased by $760 billion. China's global exports increased by $1 trillion. So China was a clear winner last time. This time also, by creating a very high tariff, by putting very high tariffs on China and lower on others, the movement has already started. You know, hundreds of investors, US investors, Chinese investors are roaming around the world, including in India. They are saying, okay, you buy intermediates from China and do the finishing in your country and start exporting wherever you want. So that's what is happening in the past 1 month that's happening. So I think this putting high tariffs, it didn't work earlier also, and now also it's not going to work.
Okay, so just one question on the India-Pakistan tensions before I open it up to the audience. We are in a, Ambassador Kumar, we are in a bit of a tricky situation, if I can put it very delicately. What do you see, how will this impact us in terms of, because we, in the global trade situation is also not very comfortable for us. You said that we have to do a lot of things before, you know, things get back to normal for us. So this unexpected complication which has come in, how is that going to impact us as an investment destination as well as in trade?
So I think it would depend on a number of factors. I would stand by what the international firm Moody's says, which is that, you know, we don't expect this to have a lasting effect on the macroeconomic fundamentals of India, which are strong. What I'm not able to forecast is the length or the duration of this conflict. My sense is that there were 3 objectives that the terrorists had, which is one, I think they certainly wanted to demonstrate that Kashmir is not normal. Normalcy has not returned to Jammu and Kashmir. Second, they did want to provoke communal tensions in India. And last but not least, and that's the point I've made publicly, which is that I think India was making strides, and our economy is 10 times the size of Pakistan. So I think the power differential was becoming way too uncomfortable for Pakistan. It would be in their interest to slow you down. And I think that is where we need to be careful, because very frankly, we have much more to lose than Pakistan. They have pretty much reached rock bottom. I mean, you know, where do you go from here? But I think you are looking at now the 4th largest economy, bidding fair to be the 3rd largest economy, and so on. So in that sense, we have more to lose. But I also think, frankly, that what is being tried by Pakistan is to test your air defense system. And they're trying to see where you are with regard to military preparedness. In that sense, I think they're using Chinese equipment, they're using the equipment that they have, and I'm sure we are trying out our S-400 as well. So my sense is that, that there will be de-escalation sooner rather than later, and then it will not have a lasting impact on, or it will not create lasting damage to India's economic prospects. That would be my guess at this point. Kind of an evolving situation, so you have to kind of take a call every day. But this is my assessment at this point.
Mr. Srivastava?
So if it's Pakistan alone, I think war will not last beyond a week or 10 days and will not have any impact on the macros, as Sir has rightly said. But what if we don't know that Pakistan is doing what it's doing at the bidding of some other nations? Then we don't know.
Okay. I guess everybody understands the subtext of that. So anyway, can I ask if the audience has any questions? Yeah, please.
So my question is to Ambassador, sir. So you asked that one of the sticking points is the agriculture and dairy. So where, you know, we put 40% tariff and they put 12%. So, and this is very, very touchy and sticky for India. So how do you think that, where do we stand with the US on this? Is there a way out? Because in India, there are so many compulsions.
Yeah, so I think you have to separate agriculture from dairy, first of all.
Yeah.
One of the reasons we walked out of the Regional Comprehensive Economic Partnership Agreement was also dairy. So I remember meeting some people from Amul, which is, I think, an amazing brand. I used to be hooked on to French wine and French cheese, but I'm now a wonderful Amul fan, actually. It's pretty good, the cheese that Amul makes. It's quite nice. So the question that you have to ask is, I asked some of them, what's the problem? Why are you afraid of Australia, New Zealand, for example, or EU? Well, one of the arguments I heard was that if you have these tinned milk powder coming into rural areas in India, somehow there would be propaganda and the mothers may be told that this and this is better than the milk that you're getting in aluminium cans, which is of doubtful quality and so on and so forth. So dairy is, I think, a sensitive area, and I think I recognize that. As far as agriculture is concerned, I am somewhat of a liberal in that sense. I'll be honest with you. I'm from the south, so full disclosure. I personally think there is too much of rice being grown in the northern part of the country, which was fantastic because you guys saved us from starvation 40 years ago. I'm happy to bow in front of all the North Indians. But at some point, you guys have to stop producing rice. There is just too much rice. The water that you need for rice is 20 times more than that of wheat. Punjab is becoming a complete barren desert. So ag reforms are important. And if these FTAs can encourage us to make those reforms, the only thing I wouldn't advise in the case of agriculture, recognizing the political sensitivity of it, I'm not an idiot, I understand it's politically sensitive, we will have to give them a transition period to farmers and say, listen, please shift to cash crops in the next 3-4 years. We'll give you MSP till then. But don't tell us for the next 100 years you need MSP. You know, the minimum support price. That is simply not on, because it's a drain on India's resources as well, isn't it? Now, how to solve this problem in the immediate, because Mr. Donald Trump is not going to listen to you, and we will have to somehow open up our market. The WTO trade experts will talk about a tariff rate quota. So what I can do in the near term, let's take apples for the sake of expediency. It can be the same for other things in agriculture as well. But let's just take apples. I cannot bring the duties from 50% to 0% for every apple that comes into India. It's a problem. Himachal Pradesh, Kashmir, apples are being made, so we need some protection. What I can do is, depending on the assessment made by the Ministry of Agriculture, I can say that 50,000 tons or 500 tons, whatever, hypothetical figure, of apples will be allowed every year at 0% customs duty. So that competes with your apples. It will encourage your apples to be competitive. You will have a cold chain storage, which you haven't had for 75 years since independence. So all those will happen. This 50 tons can become 75 tons the next year. So a gradual increase of what is known as a tariff rate quota. This can be done for rice, this can be done for wheat. I mean, the fact of the matter is you are the largest rice producer in the world. And the moment you stopped non-basmati rice exports, I mean, the prices went up. And now you have said non-basmati rice exports are okay from India. The prices have crashed, and Thailand and Philippines are worried. So you can no longer say, that is India, that we are just feeding ourselves. We are a big player now, at least in the rice market. The moment you become a big player and you are an international trader, you have to follow some rules. You can't say, listen, I'm going to do whatever I want. So that's part of the problem. But I think there are ways in which this can be done. And it can be done in such a way that while I think a revolutionary agricultural reform is politically impossible in India today, it seems to me incremental reform is not just should be acceptable, but it's actually necessary. You cannot continue in the same way that you are now, which is use of fertilizers, water. Yeah, Punjab you've got tremendous irrigation facilities in Punjab, and virtually no charge for electricity, right? And no tax for farmers. So there is a whole range of factors which are contributing to massive production of rice, which in the past used to be eaten by, rats and so on. But now we have, of course, Pradhan Mantri Garib Kalyan Yojana. So we are actually giving away these food grains, highly subsidized, to 800 million people in the country. 1 kilo of lentils and 5 kilos of rice or wheat, as the case may be. So I think we'll have to find a way to do incremental reform only in agriculture, incremental reform only for sectors that affect small and medium enterprises. In every other sector, I will just take a wrecking ball and reform India. Because if you ask every industry, they'll say, no, we want protection. I remember walking into a meeting once with 12 sectors of industry present when I was a negotiator. And I said, I want 3 sectors which will tell me they are ready to face unbridled foreign competition. No hand went up. We love protection, let's face it. We're making money. Why would you want foreign competition? But we want to export, of course, of course. So that, I think, has to change. And it is changing. I think it is changing. I mean, we know that we are capable of it. I mean, pharma is a good example. Shrimps is a good example, I think. And some agricultural commodities we have managed to export very well. So it's not that we can't do it. I'm only saying that mostly we are reformers when we are compelled to do it.
Any other question? Okay. Oh, yes, please.
Hello, sir. This is a follow-up to your last statement wherein you said every sector wants protection. So particularly with the tariff war that is playing out, do you foresee Indian automobile manufacturers losing out to that protection? And as a result of that, should we expect some sort of muted earnings for the Tatas and Mahindras currently? Because EU is again demanding the same level of respect that India is now going to give to US in terms of tariffs. Thank you.
So that's a tough one. I will not pretend that somebody is mysteriously briefing me on the status of negotiations and therefore I can share. So I just have to do some guesswork. My guess is, last time when we talked about this when I was still in service, I think Hyundai, South Korea and Japan in particular told us, very frankly, that their investments in India would take a hit if we open up our competition and if we bring down the tariffs considerably. And I was going to ask myself, why would a BMW bother a person who's buying a Kia or a Hyundai or a Swift, Maruti? The fact is, Indians are extremely upwardly mobile. You can walk in and get a car by paying very little. This has got the EMI culture and so on, right? So even small BMWs can become an extremely important status symbol. Just as, I mean, there used to be a time when black label whiskey was the thing, right, in Delhi households. Now you go, of course, they'll give you wine. Sometimes they'll give you lousy wine, but nevertheless, they've moved on to wine, right? So I think there is a tendency to be upwardly mobile. So that's a problem. But again, I go back to what I said earlier. The only thing we can do, Tata Mahindra, no, I don't think they will take a hit at all. That's my view. But the question is about the other, the vehicles that you have. And again, tariff rate quotas is something that we can do. Some number of cars can come in every year because the duties are high. There is no doubt about it. But the only thing I would say about the auto industry is that it is a mass employment sector. So that is important because India runs a real risk of going towards jobless growth. You know what I'm saying? We are the fastest growing economy, etc. But unless you create massive employment, then, so I would, small, medium enterprises have to be a carve out. Agriculture, part of it has to be a carve out because 60% of the people depend on it. Dairy, I think we can do with a transition period. The auto sector also, you will have to give it special treatment because in the organized sector, it's the largest employer in India. And that I recognize. It is important at a time when, you know, employment is becoming a problem. There is youth unemployment is high, women's employment is low. So you have those kind of issues. But otherwise, there are ways of fixing it. What India will also argue with both EU and US is transition periods. You know, we haven't got the time to talk of the carbon border adjustment mechanism that the EU is going to impose on Indian steel and aluminum and the rest of it, cement and fertilizer. If we can get 10 years, and 10 years everybody will give you, but the trouble I have with 10 years is in the textiles and garments, with great difficulty we got 10 years in the Uruguay round. But our industry did a damn all during 10 years, nothing. And then finally we allowed the Bangladesh and Sri Lankas of this world, and now we are competing with them. We are no longer competing with China. We are actually competing, even Vietnam, I doubt we are competing. It's basically in garments we are competing with Sri Lanka and Bangladesh today. And that is because our industry could not use the 10-year transition for whatever reason. I don't want to get into it. So if you have a transition period in SMEs, agriculture and auto, and a bit in dairy, then I think we should have a really revolutionary plan to liberalize and to face competition. You can't just keep quiet till the 8th year and then wake up and say, hey, what's going on? That will not work. But it seems to me that, again, we will do better if we reform. The last point I also want to make is on disinvestment. Only Air India is the flagship disinvestment we have got. But there are tons of other companies which are government and public sector owned, which should be disinvested as well. And I hope we can do that. So what has happened in reforms is the low-hanging fruits have been happily plucked. But the more difficult reforms, deep-seated reforms, they need to be done. And I don't think we should go into the last 2 years of the next general election. It'll never get done. This is the right time to do it. We don't have midterm elections like President Trump. So it's been a year since the last election took place. We should just do it this year, I think. Thank you.
Any other questions? Or I have just one last question before I close for the evening. Mr. Srivastava, if I can draw you in and ask you about the India-UK FTA, which we've just concluded. What is the good news out of it for an audience like this? What would you say is the good news for them?
I'm still discovering.
Ambassador Mohan Kumar, do you have anything any last words?
Yeah,
yes.
I mean, no, he's right, because I quite agree with him, because the agreement itself has not been made public. But if I am to go by what I've heard and what I have read indirectly, I think the deal is your garments, your ag exports, including shrimps and seafood, some of it I think will increase exponentially. I am hoping that we will have an easier time with visas. With regard to UK, especially, I mean, don't look for plumbers and nurses and so on. I'm talking of professionals who want to go there. I think that should become easy. In return, I think Delhi will get drunk on whiskey.
Scotch.
What can I say? Scotch is going to come in at 70% instead of 150. So you come back to Delhi airport on a lousy red-eye flight. I'm the only one going home. Everybody is standing in the queue to buy the black label. So if that, I think that should stop, and that will stop, because right now the duty is 150%. It'll come down to 75% and then goes to 40% in 10 years. So I think they you know, this is not surprising, because I'll just finish with an anecdote. As a young first secretary who was just learning trade policy, I was asked to make 250 pages of tariff concessions for the EU negotiator. UK was part of EU at that time. So I went to Brussels and submitted it very proudly and said, these are the concessions that India is willing to, at referendum, of course. The UK negotiator looked at me and said, he just pushed that 250-page concessions back to me and said, you take it home, go and tell your people, I want 0% duty on just one item. At that time, I was very curious to know what the hell this one item was. Scotch whiskey. And I said, why? He said, the consumption of Scotch whiskey in India, and in particular in northern India, is more than the entire production of Scotch whiskey in Scotland. So there is that much of fake whiskey which is being drunk. And the joke was, after the first peg, it doesn't matter anyway.
Well, on that cheery note, On that really cheery note, can I request Neil to address the panel? And
gentlemen, I just have one out of syllabus question for both of you, although it's part of the syllabus of this event. So if you had to allocate your money as a investor, as a stock market investor, to any market or to any country other than India, India of course would be there, what would that be and why?
Stock markets are down in China. I'll be still betting on China because they are the biggest producer. They will continue to be the biggest producer. They are the only producers of the components for most of the electronics. They are the biggest producers of the intermediates which all of the world will use. They will continue to be in that position for the next at least 10 years. So the earnings may not be exponentially high, but money will give me fair returns.
So for me, it would be Mexico, Poland. So some of the emerging countries is what attracts me, but I'm basically penniless, so I can say what I want. It doesn't matter. I don't have the money, so.
All right, gentlemen, thank you so much. We can now proceed for dinner. Thank you so much for taking the time and coming today. Thank you.